I would say that purchasing power has declined by at least 50% in the last 10 years. I'm certain that our government is bankrupt. Blockbuster didn't make any money renting DVDs. All the rental income went to Hollywood. Blockbuster made money on late fees. Banks, they make money by stealing the interest that their customers should rightfully receive, and then they make money by charging you all these fees. And technology has obviated all of that, just like technology obviated Blockbuster. All these people who think that this technology is going to make banks better, they don't understand. It's going to make banks disappear. When technology comes for you, you're dead.
Welcome to the Porter & Company Black Label Podcast, your home for provocative insights that lead to lasting wealth. And here are your hosts, Porter Stansberry and Aaron Brabham.
Live from New York, it's Porter Stansberry with another Black Label show. Porter, how you doing?
It's a little too live, Aaron. I apologize to everybody. We were supposed to record this a couple days ago, and I completely forgot. I got lost in my calendar, and anyways, Aaron just buzzed me and said, "You're 10 minutes late for the show," and I just got back from the gym. I threw a hat on, but take a look at my my New York abode here. My wife did a beautiful job decorating. We're up here on the 60th floor in Hudson Yards, and I just wanted to thank everyone for giving me such a nice place to live. I'm very grateful.
Yeah, so Porter, by the way, coming up, we'll have our very special guest, someone that you have high praise for the book. And let me tell you who it is. It's Brett Gardner, and his book is Buffett's Early Investments, a new investigation into the decades when Warren Buffett earned his best returns. We'll have him joining us shortly. By the way, he's in New York, so maybe you guys can meet up sometime and talk Buffett, because I know it's one of your favorite subjects.
Yeah, we're not going to ruin the story. We're going to let Brett introduce the book, but I want to tell everybody, this is the very best book that's ever been written on Warren Buffett by a wide margin, and I've read them all. And not only that, I'd say this is one of the top 3 books ever on finance and investing. So if you've got any interest in learning how to be a great investor, please stay for the interview with Brett Gardner. It's an incredible book.
I'll actually stop for a week with my reptilian books, and I'll go back to Buffett and I'll read this book. This one sounds great.
Aaron, I would love for you to read this book, and then I'd love to have a podcast just about this book with you and all the cool things that are in it.
Let's do it.
We could do that in my my Power Law Investing podcast.
Deal. We've got a handshake. Let's do it.
Okay.
Okay, Porter. Let's give something useful for our subscribers. We do have a lot of ideas at Porter & Co. Not as many as we had at Stansberry Research, thank goodness. We're more honed in over here. But one thing that you were really dead set on was starting a permanent portfolio, because we get so many of our subscribers that kind of want the set it and forget it model. And I know that these are things that kind of become boring, because what you'll do is, in the past, select from the current existing open recommendations, stuff like that. It's kind of more not a afterthought. It's kind of more, well, let's just kind of take the hodgepodge of what we have and throw it together. But on this one, you spent a lot of time studying one of your virtual mentors, someone that you respect a lot, which is Harry Brown, and his permanent portfolio. Why was Harry Brown so impactful on you? Because it was a long time ago. And why have you thought about this for so long before you started this?
I had 4 or 5 really important intellectual and philosophical mentors. Doug Casey, Bill Bonner, Mark Ford, Steve Sugarud. But the guy who impacted me the most from a philosophical standpoint was Harry Brown. And Harry Brown was a libertarian philosopher and economist. And he really taught a very simple ethic, which was that you had to find freedom in an unfree world. And that was the name of, for what I thought was his best book. So How I Found Freedom in an Unfree World. And he really spent a whole lot of time devising solutions to the traps that people find themselves in life. And basically it all boils down to consent. You don't have to actually consent to using their flawed currency. You don't. You have the freedom to choose otherwise. And the permanent portfolio was Harry Brown's solution to our corrupt monetary regime. And the basics of it are really simple to understand. Harry knew that in an inflationary monetary system, there would be long periods of continual inflation punctuated by very brief periods of deflationary collapse. And because the timing of those collapses were dictated and driven by politicians and by political things, it's virtually impossible for someone outside the center of power to know the timing of those things. Today, we call them rug pulls, right? You
Right.
see it
That's
all the
right.
time. Oh, here we go. Here comes the rug pull. And everyone's
Yep.
going to lose all their money.
The
So
retail bag holder rug pull.
retail bag holder rug pull. So Harry was like, okay, fine. It's fine to bitch and moan about that. But what's the actual solution?
Mm-hmm.
And the solution is that you put your wealth into 4 different buckets. So look, you have to invest for growth because we're in an inflationary economy. If you try to retire and your retirement lasts for 25 years and you don't grow your assets, you're going to run out of money. Your purchasing power is going to get inflated away. And in my opinion, okay, I would say that purchasing power has declined by at least 50% in the last 10 years. So you've got to find a way to grow your wealth. But if you just put all your money in the stock market, you're going to get rug pulled. You know,
Mm-hmm.
if you're a retired person, you can't tolerate a 50% drawdown like we saw in 2008 and like we saw in 2000. You can't tolerate that kind of
Mm-mm.
volatility. You can't. There was a month in 2020 and February where the market declined 30% in 3 weeks.
Yeah, you can't do that.
You
Can't
can't
tolerate it.
survive that kind of volatility if you're retired. Okay, so you can't survive not growing your wealth, and you because it's so volatile, because it's not a sound system, you also can't survive the deflationary collapse risk. So what do? So you put 25% into stocks, okay? But then you hedge that by putting 25% into bonds.
Mm.
Why? Well, because bonds are going to be pretty stable. And if there's a deflationary collapse, they're going to go up in price, which will shield you from the volatility of stocks falling. All right. But listen, why would you buy bonds? You know there's going to be inflation. Yep, there's going to be inflation. So you hedge your bonds by having 25% in gold.
Mm.
So you're long stocks, but you're hedged in bonds, and you hedge your bonds with gold. So 25, 25, 25. Well, what's the last 25% for? Well, that is you just hold cash. Why do you hold cash? You hold cash so that when that moment arrives, when the 2000 happens, when the 2008 happens, when the 2020 happens, when there is a collapse of 25% or more in stocks, you have cash that you can shove into the market to continue your growth strategy. So that was the Harry Brown permanent portfolio. And I took a look at that, and I've been studying this, by the way, since the mid 1990s. So I've thought about this a little bit.
Mm-hmm.
I think the thing that Harry got wrong, and unfortunately Harry's not with us to defend himself. He passed away, I believe, when did Harry die? I think it was 2004. It was a long time ago. But Harry's not here to defend himself. But I think the thing that Harry didn't understand was that he wasn't really a securities analyst. And I don't think he ever thought about how much optimization there could be inside these buckets. So let's take stocks. You want to grow your wealth, but you don't like volatility. So why don't we scan the market and look for high return on equity businesses, high quality businesses that have very low betas. And what's beta mean? No, it's not a husband who lets his wife henpeck him all day. A beta in finance is a measure of volatility compared to the S&P 500's volatility. So if you've got a beta of 0.5, that means that asset is half as volatile as stocks in general.
Okay.
So the other thing we discovered when we looked at this was, if you're going to be a retired investor, should you own something like Facebook, or should you own something like Deere and Company? And I say that because if you're a retired investor, you've got to make sure that what you own never disappears. It can't. You can't afford that risk. And so we went looking for these companies that have this Lindy law effect. We went looking for companies that have operating histories in excess of 50 years, that dominate these businesses so completely that you can't even, it's impossible for you to think of a tractor without thinking of John Deere. It's impossible for you to think of a beverage without thinking of Coca-Cola. It's impossible for you to think of a cigarette without thinking of Philip Morris. So we wanted high quality, so high return on equity companies that have Lindy lifespans, they're here forever, and completely dominate their markets. So we went and picked a bunch of those stocks to be our stock bucket. And that's something that Harry Brown didn't think to do or didn't think was necessary. He just owned the S&P. I think that we can do better than the S&P by investing in high quality businesses, ROE high companies. And I want the additional security of being in a Lindy company, a company that's been around for more than 50 years. Okay, so high quality and Lindy. In the bond bucket, this is where I had my biggest discrepancy with Harry. I didn't want to own 20-year long dated US Treasury bonds because I'm certain that our government is bankrupt. I'm
Mm-hmm.
certain they're going to have to default or they're going to have to pay off those bonds by printing more money. I don't want to own that asset, but I need some exposure to bonds. So Aaron, why don't we go find who is the world's best bond fund manager? Who can actively manage bonds better than anybody in the world? And
We might actually have them.
you're thinking, well, I've got Marty Fritzen. Yeah, but
Yeah.
that's distressed corporate
That's
bonds.
distress. That's
That's
not
the
something
same
you
thing.
want
Not the
to hang
same.
your hat on.
That's not the same thing as a government bond. That's not a sovereign
Right.
bond. Okay. Yeah. Well, you think, well, then you got PIMCO. You've got guys
Mm-hmm.
like what was his name? Not Bill Gates. Who's the
Bill
Bill
Gross.
Bill Gross.
Yep.
And then and the new guy at Double Line Capital. His name escapes me right now too. But anyways, no, I don't mean that. Because why? Because you have to pay those guys.
Right.
I don't want to pay any. I just want
Mm-hmm.
someone to manage my bond risk for me for free.
Mm-hmm.
In fact, it'd be better if they paid me a dividend. And if you
Yeah.
go
Yes.
and you study property and casualty
Casualty
insurance
insurance.
firms, what you discover is that their market caps equal the size of their bond portfolios. So if you go look at W.R. Berkley, it's a $20 billion company. It's got $20 billion worth of bonds. And it just so happens that Bill Berkley is probably the best sovereign bond manager in the history of the bond markets. And he's working for me for free. In fact, he's paying me to,
Right.
to hold these bonds. So what I did was I said, listen, let's not buy bonds directly. Let's buy insurance companies that own lots of bonds so we get underwriting profits and so we get great bond managers. So that's a big difference in our permanent portfolio. So we've got on the stock side, we've got high return on equity companies that have Lindy historic characteristics. On the bond side, we got property and casualty insurance companies, and we're great analysts for those. We have the very best P&C firms for you laid out. And then when it comes to gold, well, no offense to Harry, but in a lot of ways, Bitcoin is better than gold.
Mm-hmm.
You can send it on the internet. It has the advantages of the blockchain security. It's a superior form of payment.
Institutional
And
money is piling in. Sovereign countries are piling in. It's not going away.
it's definitely not going away. So what I said was, let's not just own gold. Let's also own some Bitcoin.
Mm-hmm.
And listen, when it comes to gold, I've been around a long time. These streamers are the best way to buy gold. Why? Well,
Royalty
because the
companies.
streamer comes in and says, I'm going to go buy all the gold in the ground now. And then you get to
Mhm.
pay me this gold over the next 20, 25 years. So it turns out that if you were with a high quality gold streamer, then you can actually make more money off of gold than just owning gold. So I said, look, let's own some GLD, let's own some gold, but let's also own the best streamers and let's own Bitcoin. So our gold bucket is a little bit more high performance than Harry's. And then our cash, this is the last part of it. And we haven't yet been able to take advantage of an opportunity with our cash. But our cash portion, the 25%, is not going to be fixed. What we're going to do is we're going to wait for an opportunity in distressed corporate credit. We've got Marty Fritzen guiding us, so we'll know when it's time. And when
Mhm.
it's time, we're going to push that cash into high yield distressed corporate credit. Ideally, when we're going to be able to get about 15% annual yield on it.
And you've seen this happen. You've seen this happen.
Yes, this has happened in my career. I would say it's happened at least a half a dozen times.
And these were the times that you literally have told people, if you really understood how to invest in corporate debt, you'd never invest in a stock ever again, period.
Sure, if I can lock in 15% yields for 7 years, I would much
Yeah.
rather have that than a stock. Absolutely, no question. So I don't know exactly when we're going to get the perfect setup where the permanent portfolio will perform perfectly, but there will come a year where we do, double-digit return in our stocks. So let's say 12%. All right. We do double-digit return in our property and casualty stocks because of a good bond market. So let's say another 12%. And we do 12% in stocks, in gold and Bitcoin. and we do 12% or more in our cash. And in that situation, you're going to have a permanent portfolio where you're earning 12 to 15% a year with virtually no volatility. Now that sounds great, but it also kind of sounds pie in the sky, doesn't it? Oh, how are all the stars going to align where all the buckets do good? Well, I'll tell you this: we started last fall.
Right. Last
I don't
September.
think, I don't think last fall was anybody's idea of the perfect time to launch an investment fund.
Certainly not.
But we now have earned 20% returns. That's 30% annualized. And we have a volatility that is half of the markets, which leads us to a Sharpe ratio of 2. So this is trouncing the market. It's more than double the market's return in the period.
Yeah, so Porter, I had
Half the
Jared. I
volatility.
had Jared pull the S&P since inception. So since September 25th, S&P has done 5.5%, and your portfolio has done 20.
That's right. So 3x the S&P with half the volatility.
Yeah, that sounds great.
Yeah, but I'm just guessing, Aaron.
Right.
I'm just
Right.
throwing darts. What would I know?
That's what, like I said before we kicked off this conversation, and one thing that you taught me a long time ago is, especially for big ideas, it's like a shark. They need to bump up against things for a long time before they go for the kill. Like you said, you've been studying and thinking about this since the 90s. This has been something that you've wanted to do, and it was really cool to be at Porter and Company to see you develop this with your analysts, because it finally just all clicked for you. And now you've put it to practice. Volatility is something that young investors love. Volatility is not something that retirees love at all.
No.
And
No.
so this is big.
I've done the same exact allocation in my private account.
That's right. You
I've done the same-
showed me the other day, which was
I've done
shocking to
the
me.
same allocations, and my year-to-date return is 47%.
Yeah,
And
that's
I know
crazy.
it sounds like I'm exaggerating, but this thing hardly ever goes down because I've got the 3 buckets. By the way, I don't. Why has my return been higher than our published return? Because I don't hold any cash, and in fact, I've got this thing levered about 40%, so I can tolerate a lot more volatility.
That's right.
But it doesn't. I don't really have down days because if the stock market's bad that day, gold will be way up.
Mm-hmm.
Or if there's a day where gold and Bitcoin are down, then you'll see the property and casualty insurance has done well because bonds are up.
That's
So
right.
it's just these are uncorrelated asset classes, and by owning all of them and by generating alpha, meaning better than average results in each category, it is possible to beat the stock market by a wide margin with less risk. And everyone says that's impossible, but we've been doing it.
That's right. And that's what I wanted to bring up today, because I think this is a massive breakthrough. This is the reason for me, single-handedly, not everybody wants to be an active investor. Not everybody wants to trade all the time and read all the time and do all that. Some people do. A lot of our subscribers love it, but a lot of our subscribers really want to set it and forget it. But this isn't going and buying Vanguard. This isn't going and buying PIMCO. This isn't buying some garbage thing.
No,
This
you don't
is-
have to pay any fees.
Exactly. Incredibly calculated. And like you said, you get paid. With property and casualties, you're getting paid for these, and for the big companies that we're investing in, the capital efficient companies with dividends, we're getting paid for these. So I wanted Porter to. I didn't really get your approval for this, but I want to give a 40% off for anybody that's not a big secret on Wall Street, because I created a domain for this. I know.
Let me explain. Let me explain, okay? Let me explain.
Okay.
I spent 30 years of my life figuring this stuff out,
Right.
okay? And I wrote it all down for you in like a 20-page document, okay? I spent my life building this, all right? And we're now tripling the return of the stock market with half the volatility. And it's actually paint by numbers. I tell you every single individual security and exactly how much of it to buy.
Yep.
And you're going to...
I'm going to give a discount.
You're just going to...
I'm going to cheapen it. But here's the thing. Look, one thing that you taught me, Porter, is sometimes you just got to get these people in. Just like with Marty Fritzen. How hard is it to get these people to buy his service and actually call and get a QSIP? So I'm going to do it, Porter. Get mad at me all you want. It may cost me my job. PortersPortfolio.com. portersportfolio.com. Please take advantage of this. Even if Porter gets a little bit upset with me, I know that the testimonials will be well worth it.
It's better just not to tell me.
You're right. I should just, I should be learning. But, Porter, I've always been accountable to you. I always will. That's the kind of friend I am with you. Well, Porter, we're running a little bit close to time to get Brett in. So let's bring him on. And I'm really looking forward to this. And, Porter, I give you my word. You got a deal. I'm going to read the book. I'm going to take extensive notes. And we should have a prolonged podcast, the Power Law podcast on this. That would be great.
That'd be really great. All right, well, let's bring Brett in.
Brett, welcome to the Black Label Show. We're very, very happy to have you.
Thank you. I'm happy to be here.
Brett, listen, I was telling you right before we started, this is the best Buffett book I've ever read. I was enchanted by the book. My wife actually read it. That's how much I liked it. She doesn't really read that much in terms of finance, but I was like, you got to read this. The stories are incredible. I want to get to all that. But first, I got to ask you, it's very rare that you read a financial book that's well written. The writing was enchanting. I didn't want to put it down. The storytelling was so great. Where did you learn to write?
So it's kind of a funny story. I was working on the book for a couple of years as I was employed as an analyst at a fund. And then the fund shut down. And I was like 30-40% of the way done with the book. And I was like, I'm just going to take the year and just do this. And I sent an early chapter of Disney to Bill Ackman, and who I never met before. I didn't know him, and he calls me up and we have like a 5-minute conversation. He's like, "You have a really interesting product here, but you need to work on your writing." So I was like, if Ackman thinks this is an interesting idea, I think that there's a lot more commercial potential than I initially thought. So I hired 2 writing coaches to help me like fix the structure, tell a story, that type of stuff. And I think my writing went from being very poor to I think I'm okay now.
Man, it's world class. For everybody who's listening, this is just the best written finance book I've ever read. The stories it teaches, the lessons it teaches, the stories it tells are amazing, but it's actually the writing that really makes it extraordinary. You don't find many financial analysts that know how to write. So really, congratulations on all that. The second thing I've been dying to know is, where did you find all this information? The amount of research that you have done is extraordinary. I've been a Buffett guy for 30 years. I didn't know about half of these stories. Where did you find all this stuff?
The Snowball, the book, The Snowball by Al Schroeder, kind of formed the foundation of the book, where a lot of the early trades were found in there. But then I kind of had to hunt for the corporate documents, the annual reports, like the proxies were applicable, that type of stuff. The first source was at the New York Public Library, where they had a lot of these old annual reports on microcard, microfiche. There's also this database that has a lot of them on PDF, which allowed.
Hold on, you went to a library?
Yes. And
Who would have ever thought of that?
not only that is that as I was like digging, I would buy books on the companies and industries I wanted to study. For example, I'd want to study like the department store industry or the hardware wholesale industry. And in the footnotes, they'd reference archives at certain libraries. So I'd call them up, ask them to scan the documents. I'd pay a few $100s, and I just kept getting these documents sent to me, and I accumulated a kind of treasure trove that helped me write the book.
Man, it's incredible. It really is. The book actually really turns into a cool history of capitalism. You see Buffett really navigating the migration of the early industrial revolution to the modern economy. And one of my favorite stories in the book is the story of Reading, the Reading Coal and Train Company, and I also love the Studebaker story. These are, companies that are in the midst of this transition and in our economy, and watching Buffett deal with really cheap companies that were cheap because they had been the victims of a technological change, like the move away from anthracite coal as a heating source. Just all these examples are just timeless. And of course, he handled most of these things well. I'm working on a Buffett book myself, and I have to admit, mine's not nearly as well written as yours. Maybe I'll get the names of your writing coaches, but But my book is called Warren's Mistakes, and everybody knows that Warren's a great investor, the best that ever lived. It's easy to laud his genius, and I do frequently. But what I also find so fascinating is to err is human, and even the world's greatest investor has made some really bonehead decisions. As you went through his early investments, um, where did you find he made the biggest mistake? By the way, either of omission or of commission.
Oh, so that's a great question. So there was one company that I wanted to do more work on and write about it, but I actually just couldn't find one which company it was, and to the documents was he invested in this like Cuban sugar company in the 50s or 60s, and it was only zero in the partnership, but it was a very small position for him. But I think the company wound up going bankrupt. That was one mistake where I don't know all the details off the top of my head, but I think the Cuban government basically just like kind of intervened and uh, stole property in a way.
In '59, it probably got appropriated,
Yeah,
nationalized, or whatever they called it.
that's what I think
Stolen.
happened, and I think Buffett talked about this in a meeting once in a while. However, like generally in the early years, like really pre-partnership, his mistakes were investing in companies with poor capital allocation, where the stock just looked cheap and management just like sucked. They would keep reinvesting in the business.
Berkshire Hathaway.
Yeah, the difference between Berkshire and the reason why I think like Philadelphia Reading is such a great case study um, is a change in capital allocation. Like in Philadelphia Reading, Ben Graham and Mickey Newman were the ones to take over and transform the company. With Berkshire, it was Buffett. But if Buffett didn't intervene into Berkshire Hathaway, it would have kind of the same result as some of these
There would
early.
have been a zero. Yep.
Exactly. It would eventually went bankrupt, liquidated, all that stuff. So you really need to change the capital allocation. In terms of the case studies in the book, I would say the biggest mistake is Hochschild Kohn, the Baltimore retailer that they bought in 1966. They meaning Buffett, Charlie Munger, and Sandy Gottesman, where it looked like kind of cheap, but it had no moat. There's no competitive advantage. The Baltimore city center was declining. Uh,
Still is.
yeah. Uh,
Yeah, that's a good tip from that story is when a family-owned and controlled business for 3 or 4 generations wants to sell, maybe they know more about it than you do.
Yeah, and one of the things that was kind of interesting about the story is so Sandy Gottesman's mother-in-law owned some equity in the company, and one of the reasons why they were like saying they wanted to sell was because they had nobody to run the business. But Cohn family remained on as owners, so that didn't really add up either. Um, I don't know if they had a sense of what would happen to Baltimore. I mean, my view is the MLK riots of '68 actually kind of accelerated the decline, but it seemed like uh, they were selling to for financial reasons just as much as management.
Yeah, it's been a lousy business for a long time.
Yeah.
When you were writing the book, did the stories, as you dove into them, did they have an impact on your own investing, like in your personal account? Did you begin to look at things differently, and if so, how?
Yeah, absolutely. So, impacted in two different ways. First, I became a lot more concentrated, meaning I remember as I was like writing the book, I'd probably have 15, 20 positions, and I kind of cut that in half. So it's 7, 8 positions instead of 15, 20. Second, there's this category of investments that Buffett invested in called workouts. The only one I write about in the book is called British Columbia Power,
Mhm.
but workouts.
This incredible story.
Thank you. Um,
Amazing.
They're essentially special situations. They're merger arbitrage, liquidations, that type of stuff. Uh, and I started investing much more heavily into those where the cash flows are predictable, but the timing isn't necessarily. Meaning, a company is going to liquidate, they're going to distribute, say, a dollar to shareholders, but you're not sure if it's going to be in 3 months or maybe a year or two.
Do you recall the acquisition? I'm not sure when you got into the financial markets. I might be dating myself here, but in the fall of '08, there was an all-cash offer made for Budweiser, and the deal closed in the 3rd week of November of 2008 in the midst of the global financial crisis. Were you in the markets at that time?
No, so I would have been entering my senior year of high school in 2008.
No.
No.
Jeez. Anyways, that was the greatest workout I ever saw ever, and it wasn't nearly as good as the British Columbia Power, but there was a $70 all cash offer on the table for Budweiser. Stock was trading at $58 a share with 2 weeks until close. I've had about 150% of my personal net worth pushed it all in. And I think I can't recall who it was on Wall Street, whether it was Icon or maybe Pershing Square, but some other people made like $100 million in that week on that merger arb deal. So yeah, those can be really extraordinary situations.
Yeah, and I think especially in like smaller cap land, there's actually more of these than people think. Small and nano cap land. I think a lot of the merger arb I think has gotten like broadly efficient in mid and large cap, but there's still like one offs like
I don't know. I made a lot of money on the Twitter merger arb, and I made a lot of money on the Microsoft Activision merger arb. And in my opinion, the particularly the merger, the Microsoft Activision merger. I don't know why I can't say that rapidly 5 times. That one for me there was just no downside. If the deal fell apart, Activision was still a great stock to own, and it was going to get some kind of huge cash payout from Microsoft. So it seemed like a no-brainer to me. So I would agree with you that large cap merger arb that's attractive is more rare, but it's still, I mean, you can still do very well on that.
Yeah, and the other thing is you're not like necessarily buying companies that are like significantly overvalued, right? Like you're not buying some SaaS company that's trading at 1,000 times revenue, where the valuation, if the deal doesn't go through, is like 50, 60, 70, 80, 90% lower. You're buying stocks whose might even be cheap at the companies at the price they're being acquired at, right? So that's another angle where you have like the downside protection, so you're able to buy into the arb.
I got one last question for you. I really appreciate your time, Brett. I'm telling you, your books is the favorite finance book I've read in 20 years. I can't
Thank you.
I can't praise you highly enough for the work that you've done. I've been a pretty severe critic of Berkshire Hathaway between 2009 and 2018. I backed off a lot of that because of the Apple investment, which was just extraordinary. And now I'm a critic again, and let me explain why. Berkshire Hathaway was always the world's best insurance company, led by the world's best investor, investing in the world's highest quality, most capital efficient businesses. And all of a sudden, after 2009, they got completely away from that game plan. They started putting enormous amounts of capital into the energy business, which is highly regulated, and of course into the railroad, which is highly regulated. And then between 2009 and 2016, when I started buying Apple, virtually everything they bought was either a relatively poor business where they were protected by a preferred security, or worse, IBM. And it just seemed like they really got away from their knitting in terms of the quality of the businesses that they were willing to invest in. And I was critical of that. Of course, they put half the portfolio into Apple, and that's the greatest investment in the history of the public markets. So I stopped chirping so much. But now they're over 30% of their book is in cash, and they've got another 30% of their book in the railroad and the energy stocks, or the energy business, Berkshire Hathaway Energy. And I don't see how they're going to outperform the S&P when they have so much of their capital tied up in capital-intensive, highly regulated businesses. And it's incredible to me that they've only taken one dividend from the entire history of the energy investments. One dividend. And they're now facing, a potential $40 billion liability from the wildfires. Like, this is a terrible business to be in. So my plan for Berkshire, which, by the way, no one's asked me to join the board. I don't think they're reading any of my comments, but I don't understand why they do not spin off to their shareholders. The railroad is a separate entity. The power company is a separate entity. Let their shareholders decide if they want to be energy investors or railroad investors, and keep the property and casualty insurance and the portfolio business. If they did that, the valuation on that part of Berkshire would be worth more than all of Berkshire is today, because that's a super high margin, super high growth business, and the railroad and the energy is just dead money. So you're like, what's your question? Well, my question is, if you were in charge of Berkshire today, knowing all that you know about Buffett and all of his investing, and Buffett's retiring and you're now the CEO, chairman of Berkshire, what do you do about these problems? How do you handle Berkshire's incredible size and, frankly, the the marginal returns it's likely to earn on some of its largest holdings.
Yeah, first, I'm very glad Greg Abel has this problem and not me, because I think it's a very difficult position to be in, to be managing $1 trillion organization. I think the probability that Berkshire meaningfully outperforms over decades is not very high. I think that maybe they can beat the S&P by 200-300 basis points, but it's very hard to have a number that you previously had. Mostly a function of size, just like there's not just not many companies that they can go out and buy that move the needle. I think the businesses they have are good. I think the energy business is good, although the returns on invested capital aren't as good as, say Apple, but, as you pointed out. Um, I th I think the railroad's very good. I still think the insurance businesses, even if Ajit Jain steps down, will be good. So they have a really good collection of assets. It's just the fact that the company's just so big, it's almost it's extraordinarily difficult to outperform. My view is that I think that when Buffett passes and is no longer chairman, um, they will institute a dividend as well as a larger repurchase program to give some of that cash back to shareholders. I don't think that they're going to spin off assets, partially because I think the way a lot of these entities are structured is if the insurance company might hold an asset that in theory might the insurance company might entirely own an asset that in theory would be spun off. And I think that unwinding that would be too difficult.
Yeah.
So I'd be surprised if there's, a breakup of Berkshire, but I do think that there will be dividends. I do think there will be repurchases. Um, I think from what I've heard about Greg Abel, he's great. But there's only one Warren Buffett, and even Buffett's had a difficult time allocating capital over the past 10-15 years, just because they're so big and there's so few opportunities that can move the needle.
I said that was the last question, but I lied. There's one more. What's your opinion about the likelihood of success for Bill Ackman and his plan to turn Howard Hughes into a Berkshire-like permanent capital vehicle?
So I'm very bullish on Bill Ackman. I actually don't know all the details of the Howard Hughes investment, um, but I would bet on him. Um, I think it's a really interesting idea. I think Ackman's right that you need a permanent capital vehicle to um, manage capital over the long term, and he's already done that in different ways, where he has like the closed-end fund trading in I think it's Amsterdam. Um, but that's not as efficient of a vehicle as he needs to be for a bunch of reasons. So I really like the ambitions to do it under Howard Hughes, especially I've never done work on it, to be clear. But
Okay. So I'm here to do some more work on.
it seems like he thinks it's cheap, so it's kind of a good. He's stepping into a asset that's he thinks is undervalued, and then he can reallocate the capital the way he sees best. So I'm bullish.
Well, great. Well, thank you so much for your time today, Brett. It was great to meet you, and I thought your book was extraordinary. Are you going to write another book?
Not anytime soon.
Well, listen, I hope the sales are great. I'll keep pumping it up for you, and I'd love to get together with you in New York at some point.
Yeah, same here. Thank you. Thanks for having me, and yeah, I'd love to meet you in person as well.
Porter, high accolades when you say it is the best Buffett book you've ever read. Literally.
Yeah, for sure. It for sure is the best book about Buffett. I would also tell you, I think it's top 3 all-time best books I've ever read about finance or investing in general. The stories are incredible, and it's incredibly well written. And you could see Brett's obviously a very intelligent, gracious guy. Great.
Yeah, I think one thing that you brought up to me that I think was interesting, I never really, I think about, obviously, I think everybody thinks about Buffett's age, but I wasn't putting together that when he started investing capital, all the different kind of paradigms and epochs that we've lived through. How much have things changed? Technological revolutions, Moore's Law. I mean, for the most legendary investor to keep up on things, most people kind of become dinosaurs and they get left behind. And, maybe you kind of alluded to that with the energy and the railroads, but Apple, I mean, like you said, he saw things in Apple that you would have to be savvy with technology to see.
Yeah, I think that Buffett has made a point his whole life that he doesn't invest in technology. He doesn't understand it. He doesn't try to. And it's kind of ironic because he was very close friends with probably the best technology entrepreneur of the last 50 years, which is Bill Gates. I mean, they were close friends since 1994. Microsoft is an incredible business, and yet Buffett never owned any of it. That's an enormous miss. That's a huge mistake of omission. I think it's also interesting. He was very close with Robert Noyce. Robert Noyce was one of the 4 people who left Fairchild Semiconductor to start Intel, and he was one of the core architects of something called the 8086 processor, which really started the microcomputer revolution. And Buffett was close friends with him. They worked together at Carleton University on their sorry, not Carleton. Which one was it? Gosh, I'm drawing a blank on the name of this university. There's a university in Nebraska, and they were on the investment committee together for this university. I don't know. It doesn't matter the name of it. Anyways, the fact is he knew Robert Noyce for 30 years, and he missed that entire industry as well. So it's fascinating how many great investments Buffett did miss. But you could spend a lot of time pointing fingers about that. What matters, of course, is that when he made an investment, he got it right more than anyone else in history. So this book really talks a lot about how Buffett sort of figures out, by actually making investments, by digging into management teams, by getting to know people, where is the best place for his capital. And it's incredible when you read the story of Philadelphia and Reading. You literally see where Buffett got the blueprint for Berkshire Hathaway, because his mentor, Buffett's mentor in finance, Ben Graham, they do the exact same thing to Philadelphia and Reading that Buffett later does to Berkshire. They completely transform the company. They start investing in new lines of business, and they fix it. And they, of course, make a very, very large profit. Buffett, and you read the book, if you read Brett's book, you'll see that's exactly what Buffett does with Berkshire. And it's just, I don't think you can really understand Buffett until you read Brett's book. Even though there's been lots of other books written about Buffett, there is no book that has this level of first source research that's been done. Like he said, going to the library, and no other book really explains Buffett's formative years as an investor. It's a must read.
Yeah, and you could understand when you asked Brett at the end if he was going to write another book, how much he put his heart and soul into this one, because Porter, writing a great book is no easy task. There are only so many great books in the book universe.
It's
he's got his up there.
It's a thankless task.
Yeah, I was talking to him before you came on, and he's obviously signed with a publisher. They give him 15%, but that 15% is after the fees, after the Amazon, after all that. You're not doing it to get rich, that's for sure.
No,
you do it as like a curiosity side quest to go down and try to produce something special for people to read and for people to learn from. And we definitely want to send that link out. So Porter, if there's anybody that's listening that's not on our email list, I want to encourage them to go to porterspodcast.com, porterspodcast.com. They can give us their email. We're not going to send a bunch of spam to them. We will add them to the Daily Journal, which, by the way, has been a big hit. It's the one place that you can go to that you get Porter's insights and our analysts' insights into the craziness and chaos that's going on in the world and all the whipsawing in finance. It's a daily crazy thing, but you always put your spin on it, Porter. Also, Porter, as we talked about at the beginning of this podcast, I really want people to join the Big Secret on Wall Street, and you granted me the ability to give them 40% off. Because I want them to have access to the Porter's permanent portfolio that we discussed at the beginning. We get so many people that write in that just get so overwhelmed with stock recommendations. They're watching Jim Cramer. They're on other investment newsletters, and people just want to set it and forget it. And as we talked about, you took Harry Brown's permanent portfolio and you put the Porter spin on it, and it's absolutely trouncing the S&P. And we've only been doing this in September, so
Yeah.
I want people to go ahead.
The permanent portfolio is on track to do 30% annualized returns and has a Sharpe ratio of 2.
Yeah, I mean that's just that's unbelievable at
It's
a time
unbelievable.
when people are so nervous to have money in the market because you just don't know if it's going to be civil insurrections or if it's going to be World War III or if the dollar's going to lose its world reserve currency status. You don't know. So Porter, for that, I do have a special URL for that to make it easy. It's portersportfolio.com.
Oh, I like that.
portersportfolio.com. However, if you're on our email list, we'll also send you that special offer for 40%. Porter, as always, we love the podcast feedback. You've been getting a ton of feedback lately. You just had your big Bank of America piece, F Bank of America. And, it made some people nervous on the inside of the company because, they get the willies sometimes when Porter gets Porter, but the feedback's been phenomenal on that. This is something that is going to be probably one of your next biggest calls. I mean, you've had several, but this financial change, especially the Genius Act, just passed in the Senate, Porter. So it's looking like a green light. So this stablecoin thing and the banks saying goodbye, good night, Irene, because they're probably not going to be around for much longer. So you'll keep writing about that.
I told our staff, I said, someday you're going to remember where you were when you read this piece because it's that important. Everything that banks can do for you, Aaron, what do? They provide security and they provide transactions. They provide payment services, right?
Right.
So it used to be, you write a check and your bank receives that check. It sends the money to the recipient of the check. It makes sure that only the amount that's authorized is paid. Make sure that nobody can get into your account but you. Right. There's the two things that it does. It does security, it does payments. All
That's
right.
right.
Well, think about that. What's more secure as a ledger than blockchain?
Nothing.
Nothing.
It's forever. Everything is exactly perfect. It's
It's
there.
very hard to explain to people who don't understand anything about technology why that's the case. But basically with cryptology, you can't alter the ledger because if you do, then the software won't work anymore.
That's
So
right.
the security is actually built into the existence of the software. It doesn't work if someone tries to steal. So it's a perfect ledger. It's the best technology that's ever existed for a registry system because, as you understand, it's all done in blockchain and the block can't be formed unless the ledger is accurate.
Yeah.
So there is no reason to have a bank to maintain security of your account. There's just not. There's no reason. There's no technological reason to have a bank anymore. And then in terms of payments, well, the internet is obviously the largest node network in the world by far. So why would you pay Visa or MasterCard or PayPal or American Express or anyone who has a private network? Why would you bother to use their private network when you can securely pay anyone in the world, any cell phone in the world, any email account in the world, instantly?
Mm-hmm.
I mean, I like to explain to people that the change that's coming to banking is exactly like the change that hit Blockbuster. The reason why Blockbuster existed was because there was no other efficient way to safely distribute Hollywood's content. So they had to lock it into a DVD, and you had to have a physical DVD to distribute it. Well, obviously, software protocols got better, bandwidth got better, and there is no reason to have Blockbuster today. So Blockbuster doesn't exist. The other thing is, I'm sure you realize that Blockbuster didn't make any money renting DVDs. All the rental income went to Hollywood. Blockbuster made
Yes.
money on late fees.
That's right.
So
I remember getting up early, hauling ass to the Blockbuster to try to get in that drop slot that looked like a little bank slot. And you got to rewind it too, or you'll get a fee for that as well. They were there to ding you for the fees for sure.
Well, so banks, they make money by stealing the interest that their customers should
That's
rightfully
right.
receive, and then they make money by charging you all these fees. And technology has obviated all of that, just like technology obviated Blockbuster. And so all these people who think that this technology is going to make banks better, they don't understand. It's going to make banks disappear. And I'm of course all for it. And
I'm definitely all for it.
the first step in that happened this week with the Senate passing the Genius Act, creating a regulatory framework for stablecoins. That's the first
Mm-hmm.
step. The next step hasn't happened yet, and the reason why it hasn't happened yet, of course, is because the banks are a very powerful lobby. But it will. And the next step is, oh, gee whiz, I have custody of my own stablecoin. It's in my software wallet. Why would, if it's my custody and it's my coin, why is Circle or whoever is stablecoin made it, how come they're receiving all the interest in the treasury bills that back it? Why am I
Mm-hmm.
not receiving that interest? And then, of course, you'll eventually have competition for that, and that will really be the DeFi revolution that will put banks out of business, because with stable coins, you could probably get paid by the minute.
Yeah, that'll be amazing.
Yeah.
That'll be amazing.
And if you need to borrow money, you can borrow money for the exact amount of time you need to borrow it.
Yeah, that's even better. And like I just got back from Europe for my honeymoon, and most places don't take American Express because God forbid they got to pay the extra 0.5% or whatever. Visa, MasterCard, you're jumping through hoops, you get it declined. There's all kinds of messes out there. I can't wait for my money just to work.
It shouldn't. There's no technical reason for any of that to ever occur. And if you realize that last year, Brabsy, when there was no legal framework in the United States for stable coins, there was $28 trillion of volume
Oh God,
into and out of stable coins.
that's mind blowing.
Yeah,
$28 trillion.
28 trillion. So people who think that that something's gonna stand in the way of this, they're wrong. What's the Lynn Alden saying? There's no stopping this train.
That's right.
There's no stopping this train. And
No, there isn't.
and people are like, oh, Uber will never be allowed to happen because the taxi cab lobby.
Mhm.
Well, look what happened.
That's right.
Oh, who could ever put Blockbuster out of business? I mean, Kodak,
You're
right?
right.
Blue chip American business.
Polaroid.
It doesn't matter. When technology comes for you, you're dead.
You're dead. You adopt or die. That's it.
And the day has come for banks, and I couldn't be happier.
Yeah, I totally agree. It's funny in Colombia, the taxis tried to fight Uber for a long time, but they just kind of operated illegally. And recently, lo and behold, the taxis are part of Uber. So you can order a taxi. And guess what? I ask every single taxi driver, hey, what do you think? They're like, this is the greatest thing ever. It's basically the same fare. I don't have to transact with cash, and I don't have to crawl down the street honking at people to get in my car. I have fares all day long.
Yeah.
All day long. So, yeah, you're right. Eventually you adopt or die. And, this is going to be very interesting and something you're writing about. By the way, for the listeners, we do edit this and we do release it a little bit late. So that is June 16th is your daily journal on Bank of America. June 16th. You don't need to be a subscriber. We'd love for you to give your email, but if you don't want to, no problem. You can go to our website and you can read it there, and you can keep up with us that way. Porter, we love podcast feedback. Podcast feedback at porterandcompanyresearch.com. Podcast feedback at porterandcompanyresearch.com. We have a lot of great things happening right now, Porter. Ever since you've come back and been absolutely dedicated, we've got our new CEO. We're getting more things done. But funny, sometimes less is more. And I know that you're working and with the analysts and looking through the portfolio. So we might have some changes there that are great for our subscribers. And we've got a lot of great things coming up that we're really excited for the rest of the year. And we have our Porter and Company conference in September where we're lining up great guests like Brett. So we got lots of great things for this year.
Let me jump in here and tell everybody, if they're interested, sign up for The Big Secret on Wall Street right now. This is my newsletter that I write every week. Comes out on Thursdays. And we're at our 3-year anniversary.
Mm-hmm.
So in July, we're going to publish a complete portfolio review, 3 years of track record. We're going to go through every single pick that we've made. We'll show you exactly where we were right, where we were wrong, what we learned, and we're going to cull the portfolio. We're going to get it down to 20 positions. So it's a portfolio that everyone will be able to invest in and follow. So if you haven't joined yet, now's the time. join. We'll go through the portfolio review with you. And as a new subscriber, you'll know exactly what to buy. You'll know exactly why to buy it. And it'll be a small enough number of positions that you'll actually be able to be fully invested and yet also be a little diversified.
You know, I love this idea. The one big feedback that we get from long-term subscribers was your annual report card that you would do on each of your newsletters. You're doing the ultimate and in-depth report card on your own newsletter from inception.
That's right. From inception at Porter & Company. Yep.
All right. Awesome. Well, thank you, Porter. We'll do this again in July. Have a great day in New York City.
Let me just say to everybody, thanks for watching. Thanks for listening. And I apologize for my attire. I got my wires crossed and I didn't have time to dress for you. I'll look better next time, I promise.
Well, I didn't wear socks today, so I'm sure I'll get criticized for that with my loafers. So bring it on, people. Send us the feedback. We do appreciate you guys. We love you very much. Thanks.
Thanks, everybody.
Thank you for listening to the Porter & Company Black Label Podcast with your hosts, Porter Stansberry and Aaron Brabham. We'll see you soon.